Thanks everyone for coming today for our Brisbane portion of our roadshow. It's great to see so many of you today, some new faces, a lot of familiar faces, so really good to see. So if I just run through a quick agenda, I've done my introduction, I'll move into some engagement bits and pieces in a minute. Stacey's then going to talk for a little while on just a few things around business structure and our recent office move. Tim will then come up and join Stacey and have a bit of a chat through our current portfolio and existing portfolio looks like at this current point in time. And then Chris will come up the front and talk you through our new investment opportunities. Lots of questions hopefully for him as well. So we like this to be open and conversational today. We certainly don't want to just talk at you for an hour. That's not the point of today. So if you have any questions, ask away all the way through and we'll answer as much as we can. Okay, so our Investor Roadshow, we sort of put this on an annual basis now. It's becoming a bit of a theme for us around the sort of turn of the new year. And we just like to get out and meet and greet all our investors at least once a year. And we try and get all the way up and down the East Coast. So we've been all the way down to Launceston a few months ago, which was great, catch up with some of our investors down there. The main places for us, of course, Brisbane, Sydney, Melbourne. And then we get out to some of the regional areas as well, Toowoomba, Sunny Coast and Gold Coast. We're always looking to come out and visit people, so if you can't make any of our venues or events, just give us a shout and we'll bring the team out to come and answer any questions you might have. So on an annual basis over the last few years, we've been talking to investors, coming out with surveys just to see if what we're providing to you in terms of our current portfolio and new opportunities is ticking all the boxes. So it's a really good insight for us just to make sure that we are providing you with those good opportunities. Accordingly, as you can see, well, it's a little bit small, but on the top left, top of the pile there in terms of sectors that our investors want to look at, industrial, the investment criteria. So top of the pile, not surprisingly there, monthly distributions. But one that's quite a talking point with our investors is length of investment and that exit opportunity. So it's something that we take very seriously. And as you can see by this chart here, so the 3 to 5 years and 5 to 7 year period is the investment horizon that most of our investors that reported back to us would like to see. So how does that work for us? We steer away from the open-ended trusts that do not have a defined trust term, and we look to those closed-ended 7-year trust types with a horizon of 5 to 7 years.
The open-ended funds are no defined term, so laws in Australia there are a life that a trust has to have, but it can be up to 99 years. So the open-ended funds will go beyond any of our lifetimes potentially, and they can acquire multiple assets. They can dispose of assets and reinvest. So the feedback through this process that we've received was that perhaps there wasn't as greater an understanding of the operation of the funds and what it would mean, for example, on the sale of an asset. Are funds returned or can they be reinvested without consultation with investors? And then what's the exit strategy? So if you have a smaller open-ended fund, like our multi-sector one is, that only has 3 assets in it currently, an exit is a lot easier. You can either sell 3 assets in one line or 3 sales individually. It's not as difficult and the value isn't as great. If you move to a fund that's getting $400 or $500 million value and it's got 10 or more assets, your buyer pool's a lot smaller to be able to take out a fund of that size in one line. So your opportunities are, do you float it or do you then sell them off one by one? And of course, selling 10 or more assets off individually takes a lot longer. And there can be significant market changes over the period of trying to dispose of those. So the ability to get out is harder. And the only way that you can get the return of your funds, unless you sell your units to someone else, is by the gradual sell down and return of funds along the way.
So next up, just move on to some of our investor reporting. Again, something that we've been working pretty hard on over the last year and a half is just making sure that, good, bad or indifferent, we're providing information to investors on a regular basis. So we've introduced quarterly reporting to do just that, essentially. So hopefully everyone in the room has seen one of our reports in some iteration in the last year or so. And And we try and cater to everyone's specific needs in that. So having some metrics in there, a one-page overview, and then we have a little bit more where we get into the nitty-gritty of what's actually going on at an asset level as well. So the flipping book software we've recently introduced from our most recent round of investor reporting. The reason we've gone to an online document viewing provider is that it allows us to see what's actually being engaged with from our investors. So, for example, up on the screen, the countrywide report that we put out at the start of May, we've got 223 investors in that fund. We saw 223 unique views of that document, which says to us that, as I say, good, bad, or indifferent, our investors are really interested in what we have to say about the funds they're already invested in. So it's a really good insight for us to say, yeah, the quarterly reports are absolutely doing what we set out to achieve. The other kind of analysis it gives us is a page-by-page look at what's actually been engaged with. So if we see no one's looking at a couple of images or something like that, we'll scrap that for next time. We'll reintroduce some other information that we think might be well received by investors. And of course, what's key to that is your feedback. So if there's ever anything you see in another report or anything that you think that's rubbish, don't put that in, just let me know. Send examples. We're not precious with any of it. We just always want to provide you as clear and concise information as possible. The Quanta cast. Our host is up the front here. Loves to get his moustache on camera. So the Quanta cast, if a number of you may have seen it, some may not, is our video podcast or VOD. I've been introduced to that word recently. The idea behind it is to provide another sort of piece of information that's not just a written document or not just a newscast down the barrel off a teleprompter. A conversational approach, as we're trying to achieve today, with the team, just to provide another bit of information that's actually enjoyable to watch. We've got two pieces that we look to within the QuantaCast. One, our traditional QuantaCast, which is focused around our investment opportunity and upcoming raises. The team go to site, they have a look at the property, and then they get together and they sort of have a debrief on camera. We think it works well. Again, we'd love your feedback on that. Secondly to that, we thought, well, we're not the experts at absolutely everything in the market, so we introduced the professional series. We're looking to get anyone in who's a professional in their own right in a different sector that we feel might be interesting. We'll have a chat with them, see if there's any ties back to commercial property. Again, just more information at your fingertips to help you make informed decisions.
We've restructured how we deliver some of the services. So previously we used to do pretty much everything in-house, in particular leasing. Very rarely were external agents engaged to provide leasing services, and we had no external property managers. What we found post-separation in engaging more with the market was that it seemed that there were some opportunities that could have been missed by not engaging more broadly with the market. While we had a very active leasing team, they only knew what they knew. They weren't having a greater exposure across the country and to new tenants who might have other requirements to expand into areas. So by us engaging with a broader sector of agents across the country, it's just opened up greater possibilities to us, and that's been a real positive. So our leasing team has reduced, that's tied into our property management. So again, we used to do that all internally. Now it's largely externalised. We still do facilities management internally because we find that's an area that we like to keep a greater handle on, but in terms of the tenant relationship and rent up, those sorts of things, that's something that a larger agency can provide at a more cost-effective way, whereas we still manage internally by having property management resources who manage the external property managers. They'll still get on the phone and they'll call the tenants, so we're still having those direct relationships. We're still getting that feedback directly, but the things that require enormous systems to get efficiency, we've outsourced. So that again has seen the reduction of what was previously quite a large property management team. Tim?
Would anyone like a top up?
Oh.
There's a lot of empty glasses, so.
Don't read anything into that. He's just genuinely asking.
This one work? Hello everyone. I'll let you have a drink now, so everyone's got to be quiet now. I'm up here. I allowed you to get one. So, portfolio overview for us, and use whatever screen you like. We've got 5 trusts, 9 assets, mainly on the eastern seaboard. We've got a property over in Port Hedland. You guys know the deal. It's usually $100,000 in minimum investment, but we do different things sometimes for our good followers. Stacey talked a little bit about what's happening internally. Just quickly on our investment philosophy or style, I'll mainly talk about core plus and value add because that's where we sit. Ultimately, we like to present things at 7.5 plus. So 7.5% return, distribution paid monthly might be a sector like health or industrial where the yields are tighter, they're more secure, we've got less risk. And then we get the sort of the speculative or value add opportunities where there's either a little bit of vacancy or development opportunity or some refurb work. And we're hoping when we put those out to you, they're sort of sitting in that 9 to 10% range as well. So I think everybody's quite conditioned. We know that we can't throw 6% at you because you'll laugh at us and move on. So just getting on to the current portfolio. So Ann Street's a great one, purchased in September 2022, returning 8.15%. We purchased for 39 mil, revaled at 59. Chris has got another reval on the way. Launceston, I was down the Launceston Retail Trust. I was down there about 6 weeks ago with Dave. We had a nice time. Lovely place, Launceston. So we've got 4 tenants in there, very good brands. So Supercheap, BCF, Beacon Lighting, and Rabobank, who just renewed for 5 years, which will be good for an upcoming val as well, Chris. Those leases are generally, the other 3 retailers are up around 2027. The idea was to ensure they're trading well, we're keeping them happy, re-sign those leases, put it to market, sell it. Paid 13.5 million, was offered 15.5 million during the DD phase, which we were tempted in some form to just cash in quickly, but we decided not to. It's returning 8%. I have to say as well, on Ann Street and Launceston and Countrywide and multi-sector, our head of funds management, that's where you pay trust management fees, he's reset the debt on all of those funds. So the way it works for us is, and I'll call it BBSY or margin, we have the current cash rate, 4.35%, and then we go and shop ourselves around the best we can to get the best margin out of the banks we have relationships with. On some of those, we've been able to take that margin from 2% or 200 basis points down to 160 or 1.6, some down from 1.8 to 1.6, but all funds that you're involved in at the moment with Quanta have had a reduction in the margin. Multi-sector, so the picture on that page there is the Yamanto Convenience Retail Centre. So it was the last purchase in that fund. There's the other 2 small medicals or health centres where Chris often gets offers on just out of the blue. It's, as we said, it's a very popular sector, health. We sold Rural View about 6 or 7 months ago. We returned some equity in June, about 1.25 cents, Dave, then 1.5 cents in July. Just now, are we in July? Yeah, we're still in July. The purchase time of that in May in 2021, we saw more than the forecasted interest rates by only 3 times almost. But so that's affected that fund. That fund is in the best cash position it's been in ever. If you look at that photo closely, on the left-hand side there's a service station, and on the right of it there's 2 other buildings. Then on the back side there's a sort of an L-shaped building. We've actually started the process of putting in DAs on each of those 3 properties, I guess, the service station, the Zarafas pad site, and then the Zambreros pad site. Our valuers advise us that if we section those off, DA those and sell those individually, we'll get a better upside when we go to sell the asset across the board. So that's the strategy for that particular fund, and we know we can sell the medicals whenever we like. There's quite long lease terms on those 2 medicals as well. Countrywide. I'll start with Westside Plaza. As some of you may know, Harvey Norman opened in May, and it's trading fantastically. The centre's never been so busy. The car parks are very busy. We've had some more lease opportunities come to us rather than having to chase them. So we've got a tobacconist going in there. We have Pets Domain, who almost signed their lease going to a space, and we also have Services New South Wales, who are your motor registry type tenant, which are going to be good for the centre to bring people there. That property is on its way up. We've got some pad deals we're dealing with on the vacant land there. I was at Emerald Plaza recently. The plaza's having a Coles. We're going through the negotiation of a Coles extension. It's about 3,000 square metres as it stands. We're looking at taking that to 4,000 square metres. Another great situation for that particular centre. At the village, village has got a major chemist, which we can't talk too much about, well down the track to go in there, which again will bring more tenants to that centre, more foot traffic. That's a huge deal for us. It's a difficult deal, but we're almost done on it, which is good. Then we can start some fit-out works. The village is, both those centres, if you've ever been to Emerald, that is an incredibly busy town. We spent 3 days there in the centres. I'm surprised how busy it is. It's got a lot of mining opportunity there. Unfortunately, there's not a lot of younger people. When I say younger people, 15 to 20, to do the retail jobs and various things, which makes it challenging for new tenants to open. But it's they're bustling towns, and the foot traffic through the centres is really strong. So if you're a Coles lover, Emerald Plaza is the only Coles there, and Emerald Village is probably busier. Port Hedland in WA is fully leased. We've got one little tiny space that as a kiosk almost, that we've got a barber looking at, but it's travelling well and always has. So that fund, honestly, is heading in the right direction. Our plan for that fund has not changed. It's to sell it down as quickly as or responsibly possible. We are committed to selling it down, but we've got some work to do, and we're doing a lot of it at the moment. And as I said, that particular unit price will go up, which would be the first time for a while, I would have thought.
I'm Chris Carrigan, for anyone who I haven't met. I've met most of you. So I'm just talking to you guys about our most recent acquisition. Happy to talk about anything that comes to mind along the way. But so we are, on Monday we released the IM for our Cunners Road Industrial Trust, which is a 9,000 metre industrial facility wholly occupied by UGL in Paget, Mackay. It's a great investment opportunity. We've been looking for a long time for industrial, this really accords with the investor surveys that we've been doing annually and talking about what investors want, which is a strong distribution in the industrial sector that provides value uplift potential. So in line with those metrics, this is as I mentioned, great tenant, delivering 8.25% average distribution over 5 years. The value upside, which is a really important part of this proposition, is that the current tenant pays $141 per square metre. The external valuer, which accords with our view, thinks that the current market rent for this is $170 per square metre, which on renewal, which happens in 4.5 years, provides an opportunity for a real uptick to achieve that reversion in market rent. And with the reversion in market rent comes a capital growth uplift as well. We like it because it's a triple net lease, and for people who, most of you will know what that is, but for anyone who doesn't, a gross lease is where the owner pays for outgoings. A net lease is where the owner pays for outgoings but the tenant reimburses them. A triple net lease is where the owner pays outgoings and capex, but the tenant reimburses the landlord for those. So the capex risk for this property for things like roof, electrical, fire, building fabric, transfers from the landlord to the tenant. So the tenant has to pay for all those, which is very unique, and that's very, except for 2 medical assets we've got, unlike any other investment proposition. So it just talks to the risk factor. It's a land-rich investment, so there's only 29% site cover on this asset. The tenant is UGL, which we'll talk about who they are in a minute. They're using more than the 9,000 square metres of sheds they've got. There is capacity on this site if they're willing to pay the rent required to justify the cost of a new build. We can actually build a 3rd shed on this site for them. We haven't factored that potential upside into our distribution model that provides an 8.25% average distribution across the 5 years, but it is an upside case. So that and that's one of the things that we intend to descend into very quickly with the tenant post settlement. What do they do on this site? So this is UGL recondition and repair large mining equipment in this site. There are two facilities of this kind. One is this one, and one is just outside of Sydney. Queensland does a few specialised repairs that Sydney doesn't, and vice versa, but there's a lot of specialised equipment. There is a lot of very heavy machinery and 5 cranes in here, varying from 5 tonne to 40 tonne. We think they're a pretty sticky tenant because it's a specialised use. There is specialised equipment within the tenancy. It's expensive to move. We've done a review of options and a sort of a surveillance of what's in a survey of what's in the market that they could potentially move to, and for the stars to align of a tenancy that's appropriately sized, that can be appropriately configured and can be made available at the time. In 4.5 years, our review of the market is that it simply does not exist. They would have to go to a new development. They'd have to triple their current rent to make a new development feasible. Future opportunities, so it would be around 200 opportunities a year that come across our desk, and they're from all sectors, retail, office, health, storage, industrial obviously. And we have a bit of a triage process. Some of it's more informal when it's just clearly something that's not going to suit us or our investors. We probably model and seriously look at 50 or 60 assets a year, where we get down and really get into looking at tenancy schedules, financial summaries, outgoings, leases, etc. And I mean, these guys do an amazing job at that. I just take the opportunity. I don't get the opportunity to say it very often, but they're just fan.
Say it when you weren't there.
I didn't say it in Sydney or Melbourne. I said I do it, but
Yeah.
no. So yeah, we look at a tonne. We probably put an offer on 30 a year. We get engagement on some of those we don't, and then we buy maybe 3. So that's the kind of funnel process that we go through. But all sectors, all markets across Australia, and they've just got to really very comprehensively fit the investor brief.